following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, your weekly source for all things volatility related. My name is Mark Longo from the optionsinsider.com, as well as the old Options Insider Radio Network. And I am joined on the program yet again, it must be an appearance record for you, sir, by my boon companion, the yin to my yang, none other than Don Schlesinger, the major domo over there at the Volatility Exchange. Don, welcome back to the show, sir.
I like major domo better than the dark side to your light side.
I try to change up your titles every week just to keep you guessing. Maybe next week it'll be Viceroy. We'll see. We'll see what I come up with next week. And we're also joined on the show by our other volatility pit reporter, the perhaps less manic half of the Option Pit team, good old Andrew Giovinazzi from OptionPit.com, aka the Maine Lobster himself. Mr. Giovinazzi, welcome to the program. It has been a while, sir.
A while for the Vol program, yeah. I've done it. I think only once. This is my second try at the Vol program.
I think you're right. I think we've only had you on once before, so let's try to make it more often than once every 6 months or so.
Yeah, trying to fill the shoes of the great Sebastian is very difficult. Yet I do try on a daily basis. Them are big cloppers to fill.
Well, you certainly need to fill your quota of uncomfortable references and 80s analogies, and then you'll be all set.
I am. I'm working on it. I actually have a list. I asked Mark, I go, what are you thinking about today? He's like, oh, good. Do Footloose today. Do Footloose today. Do Footloose. So
that sounds like something he would tell you. And listeners, we will also be joined by yet another Andrew later in the program in our Volatility Viewpoint segment, where we will be joined by Andrew Patton, the Associate Professor of Economics and Finance, with a very interesting paper called Good Volatility, Bad Volatility. So stay tuned for that. But first, we're going to dive right into our volatility review.
It's time for the Volatility Review.
And welcome to our Volatility Review. This is, of course, the portion of the show where we discuss the week's worth of volatility action. And Andrew, since you are the guest, the returning guest, as it were, on the program today, we'll give you pride of place and let you start first. What action were you watching from this past week from a VIX and S&P 500 vol perspective?
I think that the biggest action is the play between July, like post-Greek volatility and pre-Greek election volatility. And the funny thing is, with the VIX expiring on the 20th, it's just after the election. And I think basically you want to sell all the juice you can prior to the election, because there's going to be this noise. But I ultimately think the EU is going to just let the Greeks decide their own fate. If they want to go bail them out after that, they will. But they don't have to decide anything. They're going to let them all go to polls. It will make our market seesaw. So I think while we might have a little noise, I think all the June stuff is probably overpriced. That's going to expire on the 17th. And you could sell that, finance July, and basically wait, because we're either 1250 or 1360. And it's literally, we've turned our equity market into, how do you say it, an earnings play. I mean, that's what it is.
You get a nice little pop in the term structure there around the Greek election, and then you could fade it accordingly.
Exactly. So that's basically how I've been structuring things. I think the implied volatility for June is pretty expensive right now. If you own it, you're just sucking on it. You're not making any money. But the July is not coming in really at all. I mean, we've had a little bit of movement in the VIX between like around 25 and 21. But I think down at this level, it's going to be harder for people to want to overly sell that prior to any of this news, considering how badly they got torched the last time they all jumped in and tried to do it in, early August last year. And that's basically where we are.
You're not afraid of taking on that game of risk going into the Greek elections, any sort of, crazy near-term swings you might have going into that? You're comfortable with that?
I think, we've seen, I'll just say, I think we've seen kind of the market for that. We're trading a 12, maybe 1290 on the downside because there's still no resolution. I mean, we can move 1.5%, 2%. I think you just create a wide band around that. And you own a strangle and you sell another strangle. And that's how you trade it. And I would not sell any naked contracts into it. So the risk, the idea that any position like that is relatively risk controlled. But yeah, there will be for sure, we're going to keep the Greeks in, and then the left party say, well, not with the deal you're giving us. So that will go back and forth. I mean, we see it, I think, every day pretty much. There's been no news today, so that's why we're not doing anything. It's ridiculous. Everybody's sitting there just twiddling their thumbs. Oh, and as far as I just think the June, that's how the contract is going to play out to some degree. So I wouldn't want to own it. Let's just put it that way. If you have a gun to my head where you say sell it or own it, I don't want to own it. Don't want to own the pre-election juice. It's like owning juice. Yeah, go ahead.
For a degenerate premium buyer like yourself, those are strong words, sir. I like having you and Don on the show because you very much do represent I know Don loves this analogy, but the light side and the dark side, where you are, of all of our hosts, probably more on the premium buying side. And I don't know if Don, have you ever owned a contract in your life?
I try not to. See, just as long as we're separated by about 1,000 miles, we'll keep it civil.
Well, see, I remember guys when I was trading, I'd walk on the floor, and the first thing they did is they'd rip all the dark side of their tickets off, the black sides and the brown sides of their tickets. They just rip them off and throw them on the ground because we don't need those things.
We don't need those things.
That was it. We used to have 2 cubby holes, and there were the black tickets for buy and the red for sell. And I used to say you don't have to bother to fill up that left side because I'm not going to be using them too long.
I'm never buying a contract.
Just keep the red ones coming.
I love it. Well, as the token premium seller on the show, and Don, I'm sure actually most of our hosts fall into that camp. Aside from Andrew, he is the outlier. But Don, what have you been seeing on the NASDAQ side? It has been an interesting week. We always talk about NASDAQ in its relation to Apple. That's, of course, the big name everyone likes to follow. We often jokingly refer to Apple as its own index. And it sometimes has, it seems, some of those qualities these days. But there has been a lot of movement in Apple and also a lot of movement in NASDAQ as well over this past week. So what has been catching your eye from a NASDAQ vol perspective over this past week?
And of course, it fits in well with the concept that we have often talked about how you can have a movement and then basically still sort of look back and wind up not too far from where you've started, so that actual close-to-close volatility can be either flat or not represent the kind of volatility that you would swear you experienced during the course of the week. So because we report on realized volatility, I can tell you that there hasn't been a great change in NASDAQ. And you'll recall that I kind of cautiously said maybe we'd have a slight drop in the coming week. And as measured by the 21-day or 1-month realized volatility, we have, in fact, dipped below that 17 level that we had last week. And we're just a fraction under it at 1698. but all the while the 3-month realized has actually risen somewhat. And when you look at 3-month averages, you have to realize that what's happening recently is replacing what's being taken out from 3 months ago. And, we may not remember what the case was, but volatility was extremely low at that particular point around February and March, so that basically you don't have to have high volatility today to see the 3-month creeping up a little bit. It just is that it's replacing volatility that was extremely low a little while ago. So NASDAQ 1 month, just under 17, NASDAQ 3 month, just under 16. And again, from historical levels, these are still considerably lower than the typical mid-20s volatility that's associated with NASDAQ realized volatility.
There you go, Andrew. A screaming buy from Don there, or should I say a don't sell.
Yeah, right. Careful.
I know. That's the problem. The realized falls in the toilet, but the June implied is not. That's a hard trade. Even a juice buyer like me can't buy options on that. So I've got to avoid. I have to avoid that trade. So I don't only buy juice. There's not only juice buying here. I am an ambivalent juice trader, which makes me definitely an odd bird for sure.
Don't you teach the option pit juice buying course 101? Isn't that your?
We do. I actually do. I do teach that one. Mark's like, you got to teach that one. I can't teach that one.
You're one of the few people on these shows qualified to teach that one. I know I certainly would be a poor teacher of that one as well. All right. Speaking of term structure and perhaps good volatility versus bad volatility, we're going to close out this volatility review and dive right into our volatility viewpoint, where we will discuss just that topic of good volatility versus bad volatility with our guest, Andrew Patton.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
Welcome to the Volatility Viewpoint. This is, of course, the portion of the show where Don and I welcome a guest onto the program. And today's guest / victim is Andrew Patton. He is the Associate Professor of Economics and Finance down there at Duke University. Andrew, welcome to the program.
Thanks very much, Mark. I'm happy to be here.
Andrew, we're very glad to have you. And as we are wont to do with all of our first-time guests, why don't you explain to our listeners some of your background and how you found yourself falling into the very targeted area of volatility and financial volatility research?
Well, when I started grad school, I went to grad school in San Diego, and I was lucky enough to study under Rob Engel, who's a very famous volatility guy. And while I was there... Yes,
and a former guest of this program as well.
Oh, is that right? Yeah, Rob gets around. Yeah, well, so
he certainly does.
When I was there, obviously talking with Rob, a lot of the issues that came up, issues of risk and volatility and correlation and different ways of measuring and modeling these things. And this seemed like such a rich and interesting area to work on as a eager young PhD student. And so I've basically been doing this sort of stuff ever since.
So we have Robert Engel to thank for luring you to the dark side, eh? Is that what you're saying?
Yeah, that's right.
Andrew, you should know as well, and our listeners know, that the Volatility Exchange has actually partnered with Robert Engel and the Volatility Institute at NYU that I know you're very familiar with, and they routinely are providing forecast volatilities using a modified Garch approach that we publish daily on our website, volex.us. So we have a tie-in with Professor Engel as well.
Right. Yeah. His Volatility Institute has been going for a few years, and then it's been great for the field. It's been linking up a lot of academic research on related topics to people working in industry. So I'm happy to hear this connection.
Yes, we go way back with Professor Engel, and you're right. That institute has been a great point of I suppose you can call it connectivity between the industry and the academic research to try to find some sort of practical consensus on exactly what is going on in this crazy world of volatility. And speaking of volatility, Andrew, you have quite the offering of research papers that you've authored or co-authored over there. It's really a impressive array of subjects that you've researched and written on. But I think one of the ones that really speaks to us here on the Volatility Views program and to our audience is a recent paper you wrote called, or you co-authored with Kevin Shepard, I should say, called Good Volatility, Bad Volatility, Signed Jumps and the Persistence of Volatility. Now, rather than have me sum up the abstract, we have the author of the paper on here for us. Why don't you give our listeners an overview of what you were looking at with that paper and some of your findings?
Sure, yeah, I'd be happy to. So the title of the paper comes from a joke that Kevin and I used to have back and forth, that in the financial press, in the general press, I guess even more, volatility gets a bit of a bad name, that volatility is only sort of mentioned when things are going down, but strictly speaking, volatility is just movement, right? But no one really talks about movements in a negative way when the movements are up. Everyone's pretty happy when things are going in that direction. And so we wanted to sort of think a little more about the difference between things going up and things coming down. And so standard measures of risk and volatility, like simple variance, throw away the information on the direction that the price has been moving. So we're not the first people at all to think about this type of thing. This goes back at least as far as Fisher-Black in the 70s and potentially even further than that. But what we wanted to do was and what we do in this paper was to think more carefully about the information that comes from volatility in down markets versus up markets. And we're doing this, so this links up with two streams of academic research on volatility. So one is on the so-called leverage effect, which is the fact that volatility tends to react differently to downward moves in the price versus upward moves. And the general everyone is aware of is that down moves in price lead to higher volatility or bigger changes in volatility than correspondingly sized upward moves. So this is known as the leverage effect, and most people agree it actually has nothing to do with financial leverage. But one of the initial stories that were proposed to explain this asymmetry used leverage to describe it. So we investigate this asymmetry in the response of future market volatility to changes in the price, up or down. And the innovation that we bring is to sort of build on this work that's been done in the last decade or so on using high-frequency intradaily data to estimate lower frequency volatility. So in particular, what people have been doing have been using 1 minute or 5 minute prices, so intradaily prices, to estimate volatility over a day or a week or a month. And at first it can sound a little weird to think that the volatility of a return on a stock over a week can be better estimated by looking at the thing every 5 minutes. But there is some very hard statistical theory that I don't quite fully understand that shows that this is the case. And so what we do is to use this high frequency intradaily prices, and we break up these prices into upward moves and downward moves. And we moreover break them into big moves and small moves. And the big moves in this literature are known as jumps, and these have a technical definition statistically, but broadly speaking, you can think of a jump as simply a move that's more than 3 or 4 or 5 standard deviations. And what we find is that jumps are very informative for predicting future volatility, but only if we capture the sign of the jump. So this contradicts some earlier research which showed that future volatility of the return on a stock tends to be more related to the volatility of smaller moves and not so related to the volatility of big moves, big jumps. And one story for why that might be the case is that big jumps are kind of rare, and the market processes the information from that price change and then sort of moves on. But what we find when we break jumps into positive and negative components is that the positive components lead to a slight decrease in future volatility. So a big jump up in the price, this is the good volatility. When the price jumps up, volatility tends to go down a little bit, but not change all that much. But when the price jumps down, this is bad in two ways. Number one, the prices jump down. But number two, it leads to a big and persistent increase in the volatility over the coming days and weeks. And so this is what we mean by good and bad volatility.
So you're taking advantage of what has been a well-known fact, like you said, in the options market for years. I mean, all you have to do is look at the volatility skew graph to see the bias towards the downside from a volatility perspective. You're taking advantage of that kind of well-known fact and modeling it a little further to see that substantial downside jumps are much better predictors of future elevated levels of volatility.
That's exactly right. And one of the things we can do with this high-frequency stuff is to see whether information from the sign of these jumps within the day adds anything relative to the overall direction of the price move over the whole day. And we find that there's a lot of information from within the day. So just looking at the close-to-close type change masks some of the movements that happen within a day and then are reversed by the end of the day.
Andrew, I was able to skim the paper but not read it completely, so some of the questions or observations that I'll have for you right now are sort of off the top of my head in response to what you've just said, but I'd look forward to your comments on it. I think it may be true that true surprises and jumps to the downside very often come out of the blue and therefore surprise us and lead to these gaps downward that in turn lead to increased levels of both realized and, of course, implied volatility. But you'll correct me if I'm wrong. I think that very often some big jumps to the upside are not so much independently just springing up on their own, but very often are sort of correlated to the down moves in that they are a bounce back or a response from very big down moves. And historically, some of the biggest upward moves in the market haven't just come out of the clear blue and surprised us one day, but actually followed some of the bigger down movement. So I'm wondering if part of the reason for the extra significance of the down moves in predicting volatility might be that they are the true new information, if you will, when we have a big down move, and that can lead to volatile times and perhaps more of the same, whereas some of the upward volatility may just be bounces from the down moves and things evening out a little bit, which intuitively, to me at least, might have less predictive value for future volatility. Does any of that make any sense to you?
Yeah, absolutely. It makes a lot of sense. Yeah, so the degree to which these jumps or these changes in the price are anticipated certainly will affect the informativeness of them for the market going forward. And if positive jumps tend to be mere corrections of previous downward jumps, then the information is sort of already out there. So that would be consistent with what you were thinking. So in the data that I've looked at and the papers I'm familiar with, most people find relatively low, quite low persistence in jumps. So that is that jumps of either sign tend not to be particularly correlated with previous jumps. So they tend to, of both sides, tend to come out of the blue. But I have not seen anyone look at whether positive jumps tend to be predicted by lagged negative jumps in particular. So that's something I can't comment on directly.
Andrew, how granular can you get in these predictions? I'm curious. I know a lot of our practicing listeners will be curious about that as well. Let's say, for example, you see a 3x standard deviation move to the downside. Did your research find that typically correlates on average to X% increase in vol over X number of subsequent days, and then a 5x standard deviation corresponds to Y percentage move? Or how granular did you get in your findings from this?
So we looked quite granular, but perhaps not as granular as that. So we looked at how persistent jumps are across multiple days into the future. So we were looking out to 60 days, which is reasonably far for volatility prediction. And we find that these jumps have long-standing predictive power, even out to almost sort of three months into the future. The models that we used and that most people use have a sort of a built-in assumption that the impact of a jump on future volatility is linear. So a 3 standard deviation move will have half the impact of a 6 standard deviation type jump. And that's mostly done for statistical reasons because, fortunately for us, we don't see too many 6 standard deviation jumps. So trying to model those separately would be hard econometrically, statistically, and also, would also be bad for all of our pension savings.
So, Andrew, to me, of course, this is rather important research because what you're obviously finding and claiming is that all volatility is not created equally, and that basically the sign of the movement and not only the magnitude is important for predictive purposes. So with all respect to our mutual friend Rob Engel and all of the predictive work of Garch models, to my knowledge, the Garch modeling simply takes the stream of returns, weights them in a particular manner with more weight given to the more recent volatility, but without any kind of consideration of this signed movement that you've been studying. So if I could summarize, is it fair to say that perhaps your feeling is that you've built somewhat of a better mousetrap and that this would be an enhancement to existing Garch modeling, that not only does everything that currently applies to Garch need to be done going forward, but that now the sign of the movement and what kind of volatility we have should also play a role?
Absolutely. And I wish I could take credit for the idea that the sign of the return affects future volatility differently for positive versus negative. Unfortunately, I'm about 20 odd years too late to do that. So I'm merely contributing to a line of research that is built on the Garch model of Engel and Boleslav later on to allow for the sign of the return to impact future volatility. What we do in this paper that is particularly useful for volatility forecasting and is building on this long line of papers that try to build better mousetraps, better ways to predict future volatility, was to look at whether the sign of movements within the day carry any information. And a lot of people, including Kevin and I when we first started, maybe were a little skeptical that the little jiggles up and down through the day actually add up to something that carries information beyond just did the stock close up or down relative to yesterday's close. And we find that they really do. They have a lot more information than merely the sign of the daily return. And so by zooming in and looking at whether a given day contained a big negative jump or a big positive jump or neither, tells you a lot about future volatility. And I guess this goes to how market participants, how people who are trading in these markets react to this type of news. So good news arriving in the form of a jump tends not to lead to much future uncertainty. Perhaps that positive jump is more often a resolution of uncertainty. And so things sort of stabilize after that. Whereas a big downward move seems to be taken as a signal that times are even more uncertain than they were before. And that this is very, very useful and very, very long-lived.
So I have a question for you, Andrew. I'm sorry, this is the other Andrew. Did you try to separate out your data from a known event to just sort of volatility or passing surprises? So, for instance, like everybody likes to play the earnings game. So for all customers and clients and what have you, I've always been under the assumption that obviously after earnings is probably a better time to play any type of trade, because most of the news has already been resolved, at least for the short term, right? Probably for the cycle. So I think what it sounds like, though, is better earnings news tends to damp down, which I always thought anyway, so it makes a good time spread for the most part. Mm-hmm. And then, but bad earnings news, you've got to be a little more careful maybe about fading the move down than really you fade the move up, because basically bad means, well, it's bad, but it's most likely, sounds like from your research, going to be a little worse and a little choppier maybe for the next 30, 60 days. Is that?
Yeah, that's right. Yeah, that's correct. And so going to your question on the types of particular arrival of news that we looked at, so we didn't try to disentangle sort of previously scheduled announcement versus sort of random arrival of news shocks.
Okay.
So that would be a potential refinement of this analysis, that whether bad news that arrives sort of out of the blue is different from bad news that arrives at 11 a.m. because that's when the firm was going to announce its quarterly earnings. Right,
because I guess I just gave you another 3 months of data to crunch, but the idea of because what's curious too is the market tries to price in movement to some degree if they know an event, and then obviously you can't price in, which is funny is everybody kind of knew this Greek thing was happening, but they weren't quite pricing it yet. There was persistence in maybe like the TLT, and there was a slight. We'll just say the VIX looked a little high from a realized point of view, but it wasn't trading. It wasn't ramping up to 20 volatility 20 VIX anytime soon from 15. Right. Even though these things are on the horizon. So, I mean, from our clients' perspectives, trying to, obviously, where everybody's looking for tea leaves all the time. I mean, just from observation, I think I have looked at the positive earnings generally as a volatility fade, and I've actually kind of on the same assumption as the bad earnings are a volatility fade, but it sounds like maybe, that generally has not worked as well. I guess I have a good reason to figure out why.
I'll send you a bill in the mail.
Yes, thank you. Well, I just it's like sitting on the couch, and you talk to the shrink, and he's chatting back and forth, and like, oh, I discovered something.
Yeah, right.
Andrew,
the good thing or bad thing is that 95% of the market has absolutely no clue about it, which of course is good for the future of Mark Longo's volatility views and hopefully for the Volex as people start to figure it out. But of course, they might also crunch whatever edge we might be able to find in the market at the same time. But
Andrew, I'm not sure if you're aware of some of the research of another former guest of ours, Ewan Sinclair, who is at Bluefin Trading as the risk manager for a hedge fund, but is also a researcher of volatility and options theory. And we've had him actually twice on the program. And the first time he was on, he explained to us some work that he had been doing in attempting to refine volatility predictions. And from what I remember of it, he spoke again about this concept of intraday movement and sort of first touch of various thresholds where he would have a bandwidth around the current value of the underlying, which is much the same as you're saying. We look to see if the movement may be 2, 3, 4, 5 standard deviations. He would therefore have these bogeys, if you will, of how long it took for the stock to reach specific predetermined levels above or below. Now, to my recollection, he didn't distinguish between an up movement or a down movement in terms of the distance, but the thought that the intraday movement could play a significant role in contributing to a more refined prediction of volatility seems to be consistent with the work that you've done.
Yeah, absolutely. So this way of thinking about measuring volatility of a market has gained a lot of traction in the last 10 to 15 years. And one of the reasons it's gained so much traction, both in academia and also in practice, is that it works. It works very well. And it's kind of surprising that when we try to measure risk, there's a lot of benefits to looking at these sort of intradaily movements in the price. And we can't measure risk. Risk is inherently sort of unobservable. We can measure a lot better using this high-frequency data. This doesn't work so well for measuring expected returns or average returns. So statistically, if you're interested in trying to estimate the average return on some asset, looking at the price of that asset at finer and finer intervals does absolutely nothing. You get no information whatsoever. But for measuring the risk, we get better and better estimates. So in the risk-return trade-off, we can't do it much statistically on the return side, but we can improve the risk side. And so any trading strategy that involves trading off these two things, and they all do, can be improved by looking at better measures of risk. And of course, one of the things we want to do, we don't usually care so much about measuring risk for its own sake. What we really care about is forecasting risk. But when we have a better estimate of the volatility of the market at a given point in time, we've got a much better idea of what it's going to do tomorrow. If we know where we're standing now, we have a much better chance of knowing where we're going to be standing in a day or a week or a month.
Surely that makes an intuitive sense. Once work has been done, we tend to look with hindsight and say, well, gee, that's obvious. Everybody should know that, but somebody's got to be first. And I think just for our listeners, some of whom are very sophisticated from a mathematical point of view, but others who are first getting into this whole area and who are learning along with us, to me, I think it really is completely intuitive that if you study movement throughout the day and you find jumps and you find up movement and down movement, and then coincidentally you just happen to wind up at the end of the day at the same price that you opened, but with a great deal of intraday movement, I think it should be intuitive to most people that that's a different set of information than simply opening the day at 100, staying there all day long with no movement whatsoever, right, closing at 100 and saying that those two events were, exactly the same thing from a volatility point of view.
Absolutely. And the flash crash was perhaps the greatest in terms of convincing people of the intuition of this idea. The flash crash of a couple of years ago where the market didn't close so different from where it started, but boy, it was an exciting day.
There you go.
Well, I just, from the a point of view, is I just had observation being a market maker, floor trader forever. It just, you know that intraday volatility is always higher. And I guess not everybody knows that, but I mean, I feel that, so that turned me into kind of an inveterate, what do you call it? Degenerate juice buyer, Mark, because most things price close to close, right? So when we're teaching people at Option Pit, okay, here's your close to close volatility. But now let's take a look at what's going on intraday. So there's definitely, I guess, calling it two different types. You can measure volatility lots of ways. And it sounds like the research and actually providing data, I mean, there's average true range and there's other stuff right now that tries to take into account high-low, and looking at how that affects whether options are relatively cheap or expensive, because ultimately that's what we all want to try to figure out, right? You see that straddle, and is that straddle pricing the information based on the intraday movement from yesterday?
Yeah, right.
And you do see that in the pricing intraday. So I don't know if you've done the realize vol. Now if you've gone and said, okay, well, you have this move, does that provide a short-term jump in implied volatility intraday as well? And if it's not, is it do you jump on the bandwagon? I think that from a trading point of view, it looks pretty interesting, because if you're getting the snap intraday from underlying movement, but you're not getting the snap in the implied vol, that could be a nice signal where, mostly maybe because it's a name that doesn't trade very much, that's a signal to go out and buy some juice, which of course, I might be the only person in the world that loves to buy juice, but maybe Longo likes to buy some.
Don't talk about buying juice around Don. It sets him all sorts of crazy frenzies.
Well,
Don.
What's funny is we've had some clients over the last month though, that as I try to work the idea of buying juice into our professional clients, because they're already short so much, but over the last 30 days, they're like, well, we're glad we owned a little bit of it, because they forgot that volatility can expand as well as contract,
The funny part, Andrew, that I was going to comment on as you were just speaking was, as somebody, as Mark just pointed out, who probably spent 99% of his time on the trading desk being short straddles and strangles and short time premium and volatility. What I wanted to say was there's a heck of a difference between, starting a day at a certain level and being so bored to tears because nothing is happening and, counting your money as options are decaying or whatever, and a day where you're on an absolute roller coaster and you feel it in the pit of your stomach and wondering if you have to pull the trigger and do some sort of a defensive trade to manage the gamma and what's going on, only to see that at the end of the day, you're unchanged anyway. And if you only had the foresight of knowing you were going to be where you wound up, you wouldn't have done anything and you would have sat on your hands. So sure as hell makes a difference to a trader and to his stomach as to just how you're unchanged, not just looking from close to close.
Well, yeah, or you could have the thrill of just getting run over every single day. Oh, let's go do it again tomorrow. That's kind of what JPM is going through right now. I think they're watching their juice their time spreads continually expand and expand and expands, and they're really waiting for this Greek election to be over. I think if anybody's really waiting, it's the guys that are running that gigantic book.
Now, speaking to both Andrews, I think that another point to be made, as you mentioned, realized volatility and the potential for realized volatility contracts that we're looking forward to bringing to the marketplace will be that, we really don't have any empirical data at the moment to see how such contracts trade intraday. But it also seems clear to me that even if the formula is the classical standard deviation or volatility formula that's close to close and on which the settlement price will be based, there's clearly the argument that as you're trading these minute by minute and hour by hour during the course of the day, that there's more to their pricing than just either the historical period that's actually been logged and the realized volatility that you already know for the product, but the part that remains, the part that does still involve a forecast volatility, a relation to implied volatilities. And as you said, Andrew, if this is something that would not necessarily show up instantly in terms of changes in implied volatility, which really are going to impact the price of even a realized volatility instrument, then surely that's the basis for looking at potential trades. And it's going to be exciting when we bring them to the marketplace to see how they will trade intraday.
Also, too, my big question for Andrew. So have you taken your goodies yet and started throwing some contracts around? Your research?
No, we haven't. No, we're just humble university professors. We don't do that type of stuff.
He puts it out there for the rest of us to chew upon and to spend our dollars testing.
I'll tell you what. I have some willing test subjects at the option pit, professional traders that love to gobble every and all kinds of research bits and trying to put them into practice.
Well, we'd love to see that, that's for sure. So, going to this question on trading of these volatility products, I think this would be a very interesting thing to see. A lot of people have talked about adding volatility to a portfolio as a hedge, with the observation that volatility tends to go up when everything else is going down. So it will be interesting to see how those things price with it through the day in relation to options contracts on related securities. So from an academic perspective, I'm very interested to see how these things go. And it seems like these types of contracts would add something to the market beyond what is currently available. There are a few volatility type products around, but they tend to be on big indices rather than smaller indices or individual stocks.
It wasn't really a question, but just we as well are excited to be bringing them to the marketplace and having an alternative for the kinds of volatility trading that have been done. And as you've mentioned, Andrew, the success of the VIX product to date has mainly been in a single area of the S&P 500, where, of course, there is great interest, and there's no denying that. But surely our intention is to bring out a wide array of these realized volatility products, and eventually down the line even on single name stocks, so that we can kind of broaden the horizon of the type of volatility trading that's currently been doing, and we're surely looking forward to that.
You know, Don, we've had such a fantastic array of guests on this show, and you bring up an interesting point earlier that we discussed so many interesting different topics with each of them. I almost want to take them all and put them in a room because each of them has different aspects and areas of research that apply and can be interestingly intertwined with others. And maybe we need to have a Volatility Views Summit where we can bring all of our guests together because, like you mentioned, Ewan Sinclair and his first-time exit scenarios, but they don't really take into account the sign of the move with those types of research. So this is something that we could apply here. We had our guest recently who looked at jump frameworks in volatility and how it applies to OTC variance swap pricing and finding the ideal strike price for those, but they didn't really apply it to more of the equity and index type models that we've seen. And also their studies were very limited in the time frame that they were talking about, whereas Andrew's study here actually goes out a substantial amount of time. 3 months from a predictive scenario is actually an extremely long time period. So I was very impressed with that in your study, that you found results going out that far. So
yeah, Andrew, that's certainly enough for me right there. I'm like, okay, that's the third cycle, baby. I could use that.
Well, NYU has annual conferences, and I'm sure you do down at Fuqua, Andrew. So I guess we're lobbying for the first annual Volatility Views Summit, huh?
I think that would be a good plan down the road. We can get all of our guests together and pick all of their brains simultaneously and come up with one super paper that encompasses all known aspects of volatility research. I like that. What do you say? I like it.
Sounds great.
Well, Andrew, thank you very much for coming on the show. And before you go, why don't you give our listeners a little bit of a tease for any upcoming research or papers or lectures you may have coming up that may interest our audience, as well as how they can go about finding them?
Well, I guess one related topic I've been working on lately, and I just finished a big, much longer than I'm sure your listeners are interested in reading, survey paper is on flexible models of dependence. So we've been talking all about risk of individual stocks or assets. And in this line of research, I've been using copular models. So these are models that sort of generalize correlation to other types of dependence. So we can capture things beyond simple linear correlation, linear beta type measures. And so one of the things I've been working on jointly with a PhD student here at Duke is on how do we model the dependence between large collections of stocks. So for example, in a paper we've just finished, we look at the dependence very generally defined between returns on 100 stocks. So we pick every stock in the SP 100 index and we model them jointly, all together. And what we're really interested in that line of research is to think about how do we even think about dependence between 100 different random variables, 100 different stock returns. And so the types of things we're thinking about are models that can capture days where 20 stocks all crash at the same time. What are the properties of those types of days, and what does it mean for the other 80 stocks that are in the under analysis? So standard sorts of linear correlation type models don't distinguish, like we've been talking about, between up and down markets. An up move is the same in linear correlation as a joint down move. Whereas what we see in financial markets is very much the down moves are very different from up moves. So in the paper I was talking about before, good volatility, bad volatility, it's true in an individual stock sense. It's perhaps even more true in a multivariate sense when we're looking at multiple stocks. As you might expect, if you have a portfolio and half of those stocks all go down, that's a very different day than a day when half of them all go up. And so what we've been trying to do in this paper is to build models, so sort of extensions of the Garch model to multivariate applications and multivariate applications where we can capture joint crashes in a sort of a flexible but feasible way.
Andrew, that all sounds very interesting. I wish we had time to get into all of that as well, but unfortunately we do have to move on with the rest of our show. But we want to thank you again for joining us here on Volatility Views. We encourage all of our listeners, if you want to learn more about Andrew's research, then surf on over to the Duke University website, search for Andrew Patton, Patton. You can find all of his research and his abstracts there, as well as some of the interesting things he has coming up, including those cupola models that you just discussed. And Andrew, we'll certainly have to bring you back again down the road where we can look at some of this interesting new research you have coming up and how that might interest our Volatility Views audience.
Thanks very much, Mark. It's been a pleasure to talk with you today.
Great. Thank you, Andrew. Okay, and that is going to do it for our Volatility Viewpoint segment. And now we're going to dive right into our Crystal Ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball. This is the portion of the show where we prognosticate wildly about the future of volatility and what volatility action we expect for the coming week. And Andrew, since you are the other guest on our show today, why don't you take pride of place yet again and go first? Obviously, we talked about it at the top of the show about the term structure right now from an S&P vol perspective and how you're seeing that little blip around the July Greek election date. So I'm assuming you're going to stick with your prediction of selling term vol and then buy the juice post Greek election and do that spread all day long.
That's kind of the idea. Let the theta pay for it, and then just close your eyes and wait. Right? That will be my airplane trade, and that's what I think. I do not think, unless we get the crazy polling numbers coming out of Greece that basically tips it one way or the other, I think that'll be a nail biter right to the end. So that's why I'm selling. Sell that June. Sell the June, buy the July.
So that June, stock up on Tums and wait.
Yes.
Are you perhaps a stealth advocate for the antacid industry, sir?
No. So remember, we do it we are time spreading this in a way, but yes. Or you could just sell the June. I don't think this could hold up. I don't see how it does, but I could be totally wrong. But that's my prognostication. That's
all you're advocating of responsible risk management. You're no fun, sir. What fun are you indeed to not have all this naked risk lying around everywhere? What sort of advocate are you on this show for our listeners? It's terrible example.
I know, but I think I have to say it was somewhat consistent. But I wouldn't want to sell the July as much as I'm quite sure the volatility after the election will come down. You're just going to have to survive whatever they move in. You might survive the Vega, you won't survive the Gamma. Let's just put it that way.
And Don, I know you gave us your overview of the previous week's worth of NASDAQ action. I know you would never say it because you're not a contract buyer by any means, but this is certainly perhaps a period where you would be hesitant to hit the bid. Can I safely assume that?
Yes, actually, it's been for a couple of weeks that way, and I think, unfortunately, I still am a bit conflicted. If you look at charts, we've got this phenomenon that I mentioned earlier where 3-month volatility is actually rising, but I think it's not really due to anything that's happening now as much as simply extremely low volatility coming out of that particular metric and giving the appearance of rising volatility. I think the 1 month is more indicative, and the 1 month made a little bit of a run from about those very low levels of 11 and 12 up to as much as 17, but it seems to be looking like it might roll over a little bit. And so even the graphs and the charts are difficult to interpret. Again, I'm going to take the same stance as last week, and especially with a shortened week coming up with the Monday holiday. And I'm going to say that in terms of realized volatility, I still feel that the short term might be dropping a little bit more, but it's not a ringing endorsement.
He's with me. He is with me.
He's leading.
Well, great minds think alike. I guess we have to be right, huh, Andrew?
Well, yeah. Boy, if we're both on the same side of the trade, everybody better watch.
You heard that, everybody. Buy them with both hands.
Yep. Take the other side as quickly as you can, listeners. All right, and with that sage advice, that is going to close out our crystal ball segment. That's also going to do it for this episode of Volatility Views. But before we go, we'd like to check in with our cohorts here, our partners in crime, to see what's going on with them and their respective venues that may interest our listeners. So starting off with you, Mr. Giovinazzi, I know you are approaching the great option pit volatility extravaganza with the Cubs, are we not?
We are. We're going to get down to, we are going to study the volatility trajectory of home runs coming out of Wrigley Field onto the various streets around
the jump
ballpark
framework of the home runs versus bunts in the Wrigley game, in the Cubs game coming up.
Exactly. And if people are as accurate predicting prior to many frosty old styles or not. So that will be kind of our party. We'll also be teaching some options along the way. That'll be like 14th, 15th, 16th, right around there. And we're also doing our mid-June webinar on the weeklies, which will be great because obviously with the SPX expanding to the more sane CME structure of listing weekly products, that I think will be very timely. And this one I think is buying weekly juice.
Yeah, you know, we hit on this on the option block, but this is of course a great topic for vol views as well. You know, we've discussed a number of times the way weeklies have just been almost usurped as this premium selling tool, whereas on the futures options side they've been used to a much more nuanced degree. Because part of that reason I've always said is because they list the products in a much more nuanced and sane fashion, where they list the entire strip of months worth of weeklies at once. So you could perhaps, if you wanted, sell the front week and buy the third week, or vice versa, or trade ratios, or you have many more options, pun intended, for what you want to do with those contracts. Whereas the kind of just ring the bell on Thursday morning and let the dice fly approach that they've been taking on the equity options side has very much led to this just frenzy of selling we've seen over there. I mean, how many people buy weeklies on a regular basis? About 0.01%, whereas it's a much higher percentage. It's somewhere approaching half of a lot of the liquidity on a lot of these futures options weeklies, partly because it is much more of a nuanced rollout, and also a different, I think, end use case for a lot of the audience. But still, that sort of nuance just leads to more trading options for the audience and for the users, and that's always a good thing at the end of the day. So I'm glad to see that the CBOE has taken our suggestions and decided to list the weeklies in a more sane fashion.
They did, and actually, that's what they said in the circular too. We're tired of these option insider guys. Yes.
We have Mark Longo and the Option Block / Volatility Views crew to thank for beating this drum until they finally saw the light. We can take all credit for that one, Andrew. I like it.
And they should list Apple too. Just do it like the week afterward.
Yeah, the mini Apple.
Oh yeah, exactly.
They can have mini weekly Apple, and then everyone's just off to the races with all sorts of fun trading opportunities.
Absolutely.
And Don, what is coming up in the land of volex.us that may capture the attention of our listening audience?
Well, of course, the discussions go on for the rollout of products, and it's always been our intention to offer an alternative to the implied volatility products. So discussions continue, and we're making excellent progress towards that end. I'd like to point out that on the website, we try to keep the library extremely up to date, and I shot an email to our webmaster alerting him to the fact that we had Andrew Patton on the show today, and I'm happy to say that by the end of the show, which is right now, we already have up on the website Good Volatility, Bad Volatility by Andrew Patton and Kevin Shepard as the featured newest article. So those of you who listened to Andrew's fascinating discussion just a little while ago can find the paper right at the top of the volatility library under the resources section of the pull-down menu. There's also an interesting article that appeared just 2 or 3 days ago, and we're on top of that one and have featured it in the library. It has to do with the discussion that we've had many times on the show as which would you prefer to do to possibly hedge a portfolio, buy volatility call options, VIX calls, or buy puts on the underlying index? And there's a rather compelling argument for buying the volatility products, but of course it's sensitive to the time frame that was studied, and I would have liked to have seen a broader time frame. But it's an interesting article called Buying VIX Calls as a Portfolio Hedge, so listeners can check that out as well in the Volatility Library.
Yes, I think perhaps with so much recent research on that subject, Don, it might be time to revisit that topic here on the show, because between that article and so much interesting research coming out of that RMC conference a few months ago on this exact same topic, comparing SPX downside puts versus VIX upside calls and VIX calendars and various VIX ratios and which approach really outperform in many different scenarios. I think there's a lot of interesting grist for the mill from our volatility discussion on, because we've always leaned on this show on the more practical side of the direct hedge on the SPX downside, but there is a lot more compelling argument to be made these days for some of these volatility products as the hedge, particularly as they tend to outperform in some of these quote unquote black swan type events where they just dramatically go off the rails in terms of how they perform in those environments. So a lot of interesting things to discuss, and perhaps maybe we can get back into that on a future episode, perhaps when we have more time, when we're not busy with so many of these great guests that we have on the show, Don.
Yeah, and we'll surely do it because we're trying to conduct research of our own. We don't have empirical data naturally for realized volatility contracts, but we're trying to come up with the methodology that would be able to, from a theoretical point of view, recreate what a price stream might have been if there were such a thing as a realized volatility product, simply to offer that along with studies that have been done with VIX type of options, and look at these as an overlay to an equity portfolio or as a hedge for an options book and see how they might perform. So I'm looking forward to continuing with that study, and we've been partnering with the people over at IIT, and we had Professor Bilson on not too long ago, and we've actually been working with some of the students there, so hopefully it won't be too long until we come out with some of those findings as well.
Well, Don, thank you for that. And that is going to do it for this episode of Volatility Views. We, of course, want to thank our guest, Andrew Patton from Duke University, for joining us on the show. And I encourage all of our listeners to visit the volex.us website, where they can read Andrew's paper in much more detail and get more information on exactly what we were discussing today on the program. And we, of course, want to thank all of you out there for downloading and streaming and subscribing to Volatility Views and making it such a success. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments, and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.